with Investing Education Academy. This one you might have been waiting for. Like, when are we going to talk about what happened in Silicon Valley? The big bank failure of Silicon Valley Bank. What is the fallout from that? What's going to happen? Is your money safe? Isn't it safe? Is your money safe at other banks? All these things are questions you probably have. We're going to talk about it. If you have questions, this is the time to post your questions in the chat. As much as we can, we will answer them. And again, we're coming to you live today because yesterday celebrating a family birthday, so we couldn't come live. So we're going to jump in. Leon's going to tell you why we chose this topic, and I'm going to do a little bit of housekeeping.
Yeah. So the last week has been crazy in the stock market and bond market. We don't really ever talk about the bond market here. There's a lot of reasons behind that, but the bond market has been very, very important as to how the stock market acted the last year, but really last week. As Brent said, so a lot of people may or may not know about the Silicon Valley Bank that failed last Friday. We go tomorrow. The reason this is so consequential is a lot of reasons, but I'm just going to go down what happened for people that don't really understand what happened, and then we'll kind of go into the reasons. Kind of go into the effects. So basically what happened was Silicon Valley Bank was the bank of choice.
Leon, real quick. Sorry. We got a question.
Yeah.
Why did the government bail them out?
They didn't bail them out. We're going to get to that. They did not bail them out.
We're actually, there's a good story, and Leon just had like a little conversation about it off camera. So we are going to talk about what feels like a government bailout.
Right. Yeah. It's it. So to answer the question, the government did not bail them out. The government saved them, but they didn't bail them out. A bailout is what happened in 2008, where taxpayer money was actually used to prop up these banks. That did not happen this time, and we'll kind of explain what happened. But so just real quick, so what happened with Silicon Valley Bank that sparked all this was Silicon Valley Bank is the bank to all start to the majority of VCs, venture capitalists, and startup companies in the U.S. Pretty much most of the money that goes to these companies runs through this bank, right? So it's very, very foundational to the startup community. But so the reason why what the Fed's been doing over the last few years has affected these banks and the startups. The reason is because since the Fed's been raising rates, money has gotten more expensive. To borrow money is really, really more expensive. And so what VCs have been telling their companies is like, hey, we're tightening our belts, right? Like the money that some of our people that invest in our funds, they're pulling back. So we're pulling back. So y'all got to pull back startups. And so what happened was startups were not raising as much money as they were before, and they were burning through their money faster. Remember, all this money is deposited at Silicon Valley Bank. So what happened last year is billions of dollars that was in Silicon Valley Bank last year, to start the year, got burned off by all these companies that were, paying their bills, paying their employees, and they weren't raising money. They weren't raising more money because rates are going up, the economy is slowing, everyone's kind of pulling back. So VCs, venture capitalists, like, look, we're not going to fund you all either at all or as much as we've been before. So the deposit of Silicon Valley Bank depleted hugely last year. That's one point. Other point is that, and this is where the Fed comes in. So the Fed's been raising interest rates like crazy. And what really blew up for Silicon Valley Bank was when they were making all this money, all this deposits in 2021, they took those billions of dollars that these startups had put in their bank and they bought treasury bonds from the United States government, backed by the government, super safe, right? But when they bought them, the rates on those bonds were like, let's just say 1%, right? And rates on bonds today are like 5%. So what happens is, as the rates on those bonds that the government bought, when Silicon Valley Bank bought them, they were 1%. Now they're 5%. So what does that mean? That means that the bonds that Silicon Valley Bank bought, let's say a year and a half ago, are worth way less than what they are now. And so what happened was Moody's, which is a company
it's a rating company.
Yeah, think of it like almost like your credit card rating, your FICO score. They kind of give like the FICO scores to big companies, big banks. And Moody's came in and was like, look, you all had so real quick, what happened with the bonds? So the bonds that were sitting on their balance sheet that had depleted in value was huge, right? It was a huge, but it was unreported, right? So like the world didn't know about this. Only Silicon Valley Bank knew about it, regulators and these rating agencies. So Moody's came in and was like, "Yo, y'all balance sheet has a huge hole in it. You all have a huge loss that you're not reporting." There, which is fine. They don't have to report it. But Moody's was like, "Look, we have to downgrade your credit rating." And Silicon Valley Bank was like, "Holy hell! If you do that, that's gonna screw us." So what they try to do is they try to go out and say, "Okay, we're gonna sell these bonds and try to get out of this situation." Well, when they sold them, because they were worth so much less when they bought them, they basically sold them for a $1.8 billion loss. So the stupid thing is that before that the loss in those bonds was not showing on the balance sheet because they didn't have to report it. Now when they sold it, it did show. So Moody's is like, okay, well, you sold it. Now the world can see it. So we have to now downgrade you. So they got hit twice. They have a $1.8 billion loss now on their books, and Moody's downgraded them.
And Leon, real quick, let me jump in. So when Moody's as a company, if they didn't, once the sale became public, that's now public records. It's on their balance sheets, and those balance sheets are reviewed by SEC, the Fed. All these agencies see it, and if Moody's did not respond, it almost kind of forced their hand. It shows that they either have favoritism or they're not doing their job. So when it became public, they had to downgrade. I mean, they were going to do it anyway, but they now had to do it because the information is public facing. And that also led to, social media plays a big part in all this, because you do have these fund managers and these institutional investors that started sending text messages and emails telling everybody they want to divest. And so this becomes an avalanche effect. And, where we didn't have technology before, things can move extremely fast. In addition to it moving quickly, now the world in which we live doesn't require you to go to your bank to move currency. As long as you have one of these, you can move a ridiculous amount of money in seconds. So we're going to talk about why that matters in a minute. Yeah.
Yep. So Moody's downgraded them, and they got a downgrade in their books, bad credit score, quote unquote, and now they have a $1.8 billion loss. So what they did is they ran to Goldman Sachs and was like, "Hey, Goldman, who's their advisor, we got to fix this." So Goldman was like, "Okay, cool. We're gonna go out and do a stock sale and raise money, through selling more stock." Well, when this happened, as Brent said, this becomes public information. And as Brent also just said, when this happened, a lot of the venture capitalists were like, "Whoa, why is our bank raising money? They're a bank. Like, they have all the money in the world." So that really became a red flag to the venture capitalists. And they started calling their portfolio companies saying, "Look, there's a problem at Silicon Valley Bank. Silicon Valley Bank. You may want to, withdraw some of your funds." And as Brent said, that became Twitter blew up because all these, all these startups are on Twitter. All their founders are on Twitter. They're calling this the Twitter bank run, because what happened was everyone went on Twitter and was like, "Yo, I'm getting out. Yo, I'm getting out. Yo, I'm getting out." And then it fed on itself. And check this out. $42 billion was withdrawn from Silicon Valley Bank just on last Thursday of last week. In one day, $42 billion was withdrawn in one day. That is, that was unthinkable even last year. And like Brent said, I read an article. There was a guy, a founder of a company, on a plane in the bathroom he was on a plane in the air. He was in the bathroom trying to move his money out of Silicon Valley Bank with his phone to another bank. That's how panicked this was. It was unbelievable. So $42 billion left this bank, and ultimately, that's what collapsed the bank. The bank had essentially no more money. They couldn't meet that huge debt that they had, that $1.8 billion in losses. And when that happens, then the feds come in and say, "Hey, look, let's look around, see what's going on." They saw that the bank was insolvent, essentially, and they closed the bank down. But the reason this matters to us as investors, the reason it's important is because two things. One, that $1.8 billion from their bond portfolio loss was a direct correlation, was directly tied to what the Federal Reserve is doing. Because remember, they're raising rates. And when Silicon Valley Bank bought those bonds a year and a half ago, rates were really low. So just by them raising rates caused so Silicon Valley Bank failed, Signature Bank failed, And now there's a bank called Republic. What is it called? Something Republic. I'm pulling a blank. Give me a minute. First Republic. There you go. First Republic out of New York is on the precipice of failing. And right before we came on just now, heard that the two big to fail banks, Bank of America, JP Morgan Chase, Wells Fargo, you name it, all of them are now committing $20 billion. Well, excuse me, they're going to deposit $20 billion into First Republic to save it so it doesn't fail. And really, I want to tie this back to the Fed and what's going on with the market is all this is because the Federal Reserve is raising rates. It's slowing the economy. Venture capitalists don't want to lend.
Money's more expensive.
Bonds
that were thought to be amazing are no longer amazing.
Yep, the bonds that were thought to be safe, and they are safe. I mean, if they hold those bonds to maturity, they'll be fine. But they had to sell those bonds to get liquidity, to get money in the bank to try to save themselves, and that didn't work. So,
Leon, for people who don't understand how bonds work, once you buy a bond, this is really important to what Leon's saying, is you have to hold the bond. You have to hold the bond to maturity in order to receive the promised APR, with your annual percentage rate return. If you do not hold a bond to maturity, then you're going to get either a fractional or just a return of premium. So you really need to understand bonds that aren't held to maturity adversely affect you when you're cashing them out. In addition to that, most bonds, by just definition of what bonds are, because they're secure, they don't have a lot of wiggle room. So if you're not holding the bond to maturity, you're looking at possibly cutting what you thought you were going to get in half if taking it all away. So it's a very important piece to hold a bond to maturity for these banks in particular, because they determine their income based off what the assumed rate of return is going to be, because it's guaranteed by the federal government on their books, in their projections, that money is going to come in. It's not, there's no risk to that money. So when all of a sudden you have to cut that, you completely change your projected income. You completely change your profit margins. You completely change how much revenue the bank. I mean, you change so many things on a level that people just don't understand. They're like, so what's the big deal? Like what Leon said, like, what's the big deal? That's what we would think as retail investors. But also, many people don't know banks make their money by holding money as long as possible. They use that money to give loans for houses. They use the money to give loans for cars, for business loans. Silicon Valley Bank is a business loan bank. And so now all of a sudden, when you're insolvent, what happens to all the loans that are outstanding? What happens to all the people? You start calling in those loans. And if you're calling in loans to a company that you know already doesn't have income, they can't produce it. So now everything is going to accounts to bad debt, because you can't reclaim that money that you loaned thinking that you had this reserve that was going to keep you afloat. That's now gone. These banks don't make these businesses don't make actual money. So you calling in a loan early, they can't pay it back. It becomes this huge implosion of like people who can't pay people back. And that causes mass panic.
Mm-hmm. Yeah, just what you're saying, like treasury bonds. They are super safe. They're guaranteed by the federal government at maturity. But if you sell a bond before maturity, which means the day that, like, if you buy today, it's a 5-year bond, it'll mature in 5 years, you'll get your principal back plus your interest. If you sell that before that 5 years, it's just like a stock. Like the price can go up and down. And if you sell it while it's down, like Silicon Valley Bank did, they got caught huge and have a $1.8 billion hit. So that's kind of how bonds work. They're kind of like stocks before maturity, but at maturity you get principal back plus your interest. But they had to sell early to bring in some sort of cash to try to save themselves, and it just didn't work.
Yeah, and that's assuming like some bonds also have what's called a coupon rate, and that's the amount that you get back on a systematic basis. Basically, you're getting pieces of the final ROI or APR, depending on just who's saying what, in quarters or per month. And so that coupon rate can be affected also by when you sell the bond. And the reason I bring that up is you don't have to necessarily hold it exactly to maturity to get some money. If you have a bond that's paying a coupon rate, you will get incremental pieces, which most businesses, they assume that that's guaranteed income that all of a sudden gets cut.
Yep. And so, okay, so back to the market now. So the reason this is important to the market is because what happened last week. So crazy thing, last week, Jerome Powell, ironic. Last week, Jerome Powell went before Congress. He was asked explicitly, Jerome Powell is head of the Federal Reserve. He was asked explicitly, is the banking system okay? He said, no problem, we're good, nothing going on. 2 days later, Silicon Valley Bank failed. So I mean, everybody was like, dude, really? Like, did you really like are you awake? Like, what are you doing? And also last week they were talking about raising, so they raised next Wednesday. The next raise will be, they were talking about raising by 50 basis points, which again is another huge raise. 25 basis points is considered like average to low, 50 is considered high. They were considered doing 50 because inflation in January came in pretty hot. After last week, with two, possibly three banks failing and one closing on its own, the likelihood is that they'll raise by 25 basis points, pretty much the lowest they do, and then stop. And the thought is Jerome Powell next week will actually announce that we're going to raise 25, but then we're going to take a pause and just kind of see what happens, because everyone was saying the rate, the speed at which they raised rates last year was historic. There's never raised rates that fast, and everybody was like, okay, we're waiting for something to break, like something in the economy is going to break, and it did. Silicon Valley Bank, Signature Bank, Silver Lake, I think Silvergate Bank closed, like a whole stuff broke. So now the thought is that the Fed is like, okay, cool, we did our job. We've hit what they call restrictive territory. Stuff is breaking. We now need to chill. So if next week they raise 25 and they announce a pause, that's positive for the market. The market will like that. The market will likely rally. And from that point, we can probably get a little bit more of a traditional normal market. Now, what will throw a wrench in that is other thing is that this week, CPI, PPI, Consumer Price Index, and Producer Price Index, basic measure of inflation, both came in lower than expected, which is great. So inflation is coming down. And the last jobs report, something that Jerome Powell is looking at, is that wage inflation actually came down too. So everything's looking good, like, right? I mean, everything as far as the inflation front is looking good. We just need Powell now to put his, tap the brakes on his raises. And then stuff broke last week. So this is all good for the market. It's all positive because what we now know is the rate hikes are coming to an end.
A pause.
To a pause, exactly. Yeah, an end would be a whole different thing. Rate hikes are likely coming to a pause next week. Because here's the thing: if inflation does tick back up, say in a couple months, the Fed will come back in and start raising rates again. So yeah, Brent's rate, it's not a stop. It's a pause to see what happens. So this is all good for the market. This is all good. You see today the market's up huge. And our next hurdle is next Wednesday when they announce. Oh, just one last point. Today there was a rate hike in Europe, and they had their own issues over there with a bank called Credit Suisse that almost failed too. So the question was, well, what is Europe going to do as far as their Fed and raising rates? They were talking about a 50 basis point raise too, and everybody's like, oh no, they wouldn't do that. It's crazy. The market's in turmoil. The economy's in turmoil. They came out today and raised 50 basis points. So they did it. They called everyone's bluff. They went hard. She went hard. The head of their Fed is a woman named Chris something Lagarde. Lagarde went hard. She raised 50 basis points. So now the thought is, does Jerome Powell and the Fed here next Wednesday do the same thing? Do they say, do they still pump their chest and say we're going to fight this inflation thing to the end? We have to wait and see. But all that said, things are looking good in the inflation front. The fact that something broke last week in the economy and the banking system is going to put a bit of fear in Jerome Powell and the Fed. So things are looking good. We're almost on the other side of this crap we've been going through since November 2021. We're getting close. But we hope that you all still have been investing. Brent and I have. I just sent out an email today to the Portfolio Panthers of a buy that we did yesterday in the IEA account. So we're constantly active because we see what's coming, which is the end to this craziness that's been happening. So hope everyone's still paying attention and still investing.
Yeah. So we hope that this brings just some clarity to the situation for you all who have been waiting to hear it from us. I know some of you all have heard news. There's a lot of people who are fear mongers. They're putting out these statements that every bank in the U.S. is going to fail. That is not going to happen. I mean, if that was the case, the U.S. government would have failed. And then additionally, there's a lot of people who are just trying to get clicks on social media platforms. It is something to be concerned about. Let's be clear. And you want to know where your money is and how it's distributed. This is a great time to understand how the FDIC works. And some people do, some people don't. And also, what are the safeguards if you are investing? Like, what is SPIC? And we should do a live on the difference between FDIC and SPIC.
And their importance.
Yeah, the importance to one, the investment marketplace, and the other, the banking marketplace. But anyway, the point is this: stay calm. Make sure that you do pay attention to what's happening to your bank, especially people who have, let's kind of call it the local specialized banks, because those are the ones that normally have the greatest effect when things go wrong. The bigger banks, they normally can weather these things, but some of the smaller, more concentrated niche banks, they can get hit hard. As you saw, Silicon Valley, one of the most niche banks out there, and they had a direct effect from a Fed raise and also some very bad social media chatter. I mean, because truthfully, if it excluded the social media chatter, I'm very sure that there wouldn't have been the bank run.
Well, there may have been a run, just not $42 billion worth.
No, not 40 yet. No.
Yeah, there still may have been some people doing it, but I mean that was
in one day.
In one day,
you know what? That's just crazy. But so,
real last thing I want to say is the reason why this was not a bailout, quote unquote, is because bailout is when taxpayers' money is directly used to bail a company out. The reason this wasn't a bailout is because the money being used to backstop the loans for all banks is actually it's a fund that banks pay a fee into. So I forget what the fee is and what the fee is for, but it's not directly taxpayer money. It's fees that banks pay to the Fed and to the Treasury that is being used. That pool of money is the money that's being used to backstop Silicon Valley Bank's loans, Signature Bank's loans, and other banks. Yeah, so that's why it's not a bailout.
It's an insurance policy that the banks buy into, and I don't know what who is underwriting the policy, but many financial institutions, when they get started, they have to pay into this insurance fund, and that insurance fund is used for catastrophes like this.
Mm-hmm. Yeah, so it's not. That's why it's not a direct bailout. It's not coming out of the Treasury. It's coming from a fund that the banks themselves are paying into.
So with that being said, we do owe you all 2 stock picks. We will put them into the Investing Education Academy membership platform. If you are not yet a member, there's a lot happening out there, and you should be part of the community. And of course, we would love for it to be ours. You can go to IAMembers.com, sign up. There are levels that start at $17 a month, and there are levels that are $5,000 a year. It just depends on what you're interested in doing once you land on our page. Everybody, thank you for being with us, and we will see you next.
2 weeks.
The date will be, give me 1 second, the 30th. No, the 29th. We'll be back on the 29th, and we look forward to bringing some good information to you all. If you're already in the IA members platform, we'll probably see you later on this week. So everybody have